Hey, hello everyone, and welcome you all to another video on my YouTube channel. And first and foremost, I want to thank you all for taking out time to watch my content. You could be doing anything with your time. You could literally be anywhere right now, but you're taking out time to watch my content or to receive or to listen to what I'm about to tell you really means a lot to me. So I'm very, very grateful. And as usual, if you're not yet subscribed to this channel, please try and subscribe because I really put out great content that could help you in your trading career. And if at the end of the video you got value, then endeavor to like the video. Now today, this video is going to be about. What this video is going to be about is how to trade successfully through hedging. How to trade successfully through hedging. Let me spell the hedging so that you guys will know what I'm talking about. Hedging. So this is what I'm talking about. Hedging. Now, what's hedging? Hedging is just literally buying and selling at the same time. Hedging is just buying and selling at the same time. Let's say as price that is here at this point, I will just place a buy and a sell at the same time, and that is what hedging is all about. So I'm going to be showing you all how you can actually trade successfully through hedging, and how you can use hedging to actually know where the market could be going to, and so you can easily find the direction of where the forex market or where price could be going to next. So there's actually a rule to this, so I would like you all to follow me. There's actually a rule to this. First and foremost, the first thing you do is to throw a buy and a sell at the lowest possible volume. Now you throw a buy and a sell or open up buy and sell trades at the lowest possible volume. So first you buy and sell at the lowest possible volume. So let me put that down for you all. So first you buy and sell at the lowest volume possible. You buy and sell at the lowest volume possible. Now make sure you buy and sell at the same volume. At the lowest volume possible for most forex pairs, as you know, is 0.01. Though some pairs like oil might, there's some brokers that insist that before you trade oil, you should take at least a standard lot, some 0.1. That's a mini lot. But for normal forex pairs, is normally for normal forex pairs is normally 0.01. So you buy and sell at 0.01, which is the lowest possible volume. Then now, before I continue, when you buy and sell at the lowest possible volume, now let's say price is got to a level and you don't know where the it might go next. So what you do is you buy and sell at if that particular level where price is, then you just watch and see where the market is going to go next. Now if you already have an idea of where the market is going, you don't have to do this. Now note, if you already have an idea of where the market is going, you don't have to do this. This strategy is just mainly to find the direction of where the market is going to. Now once you do this, no matter how far the market goes, you only lose the spread. And what you know, if you know what spread is the difference between your buy and your sell. So if you bought at 0.01 and your spread is, and for that particular pair, 0.01, a pip is 10 cents. Let's say it's like the GBP Swiss franc, where a pip for the GBP Swiss franc at a micro lot is 10 cents. Now if the spread is 2 pips, the only amount of money you will lose when you hedge is 20 cents, only 20 cents. Now once you do this, no matter how far the market goes, you only lose the spread. Now note, sometimes the market might be, sometimes the market might be showing a bullish candle, or the market might be showing a bearish candle, but might end up closing bullish, and vice versa. And that is why it's always good to wait till the candle closes before making a decision. Now let me show you an example of what this particular. Now look at this last candle, this candle here. When the market opened, the market was going down. The market was going down, and if you are somebody that just follow the direction of the candle, you would have been faked out, because the market was going down, but before you know it, the market reversed and started going up, and you can see the market closed bullish. So it's always good to wait for the candle to close before you actually say, okay, this is where you feel the market will go to. It's always nice and always advisable for you to wait for the candle to close before making a decision. Now move to step 2. And what is step 2? Step 2 is simply you wait until the market shows you which way it is going, then you add your third trade or money trade at the volume you feel is okay for your account. Now let me put that down. Let me put that down. I see add your third trade in the direction okay, that's the maximum. Okay, let me just say add your third trade in the direction of price, or in price direction of price. So you add your third trade in the direction of price. Now what that is that you add your third trade, that is your money trade. Now let's say you have a $1,000 account And to hedge, what you do is you buy and sell at the lowest possible volume, which means you open trades at 0.01, that is 10 cents per pip, and wait to see where the market is going. Then when you find out where the market is going, you now add your third trade, which will now be maybe at 0.1, 0.05, and that will be your money trade. Then you ride it till you feel the market will turn around. Then you take the money from your, or let me not just rush, let's just flow. So as I said, wait until the market shows you which way it is going. Then you add your third trade or money trade at the volume you feel is okay for your account. Now, as I said, no matter how far the market goes, before you put your third trade, you only lose the spread. As long as you have not added your third trade, no matter how far the market goes, you only lose the spread. Now, again, if you know where, as I said before, if you know where the market is going, then there's no need to try this. If you already have an idea of where the market is going based on your strategy or your trading style or whatever, then there's no need to try this. Now that you have realized where the market is going, you add your money trade and ride the market till you see a reason to leave that trade. That is maybe when you enter at a resistance, you go ride it to support, then you can close all the trades. Now it depends on you. You can choose to close that your third trade, that is your money trade, and take the profit, because the first two trades have cancelled each other out. You understand? The first two trades have really cancelled each other out. So no matter how long you ride it, or except you leave it for days and swap is not on your side, then you can be losing swap. But if it's during the day, which I'm actually doing this video for people that trade intraday, like intraday traders, that trade during the day. So this video is actually for them. So you can add your third trade and ride it to, if you got in a resistance, you can ride it to support, then take your third trade money, or you can close all the trades and hedge again and wait till the market tells you where it's going to. Now the key is to know where the market is going to. If for some reason you are in a hedging trade and the market gives you a reason to add another trade because it looks to be going down, and it turns around you, then what you can do is to add the buy and counterbalance the trade. Now what am I saying? This is what I'm actually saying. Let's go to the 1 hour. Now let's say you started hedging, or let me just go. Let me do this. Now let's say you put your buy and your sell. No, I'm really looking for something that will really, okay, I think this is good. Now let's say you put a buy and a sell at this level. Let's say at this level you put your buy and your sell, and when you saw this candle, you felt the market was going up. When you saw this candle, you felt the market was going up, but what happened? The market turned against you and was going down. Now let's say you put your buy and your sell at this level, and you now put your third trade at this level. Now you have 3 trades going, and the market just went a little bit and turned around on you. Now you can add your another sell. Since now you have a buy and a sell, you can add another sell to lock in your deficit, so to stop you from losing more money, so you realize which way the market is going. Now the only thing about doing something like this is that you will not be losing. Maybe let's say here you realize the market is no longer in your favor, somewhere here, you will not be losing about 37 pips. Now let's say you got in at 0.01 twice, at this level. You got in, then when the market got in here, you got in at 0.05. The market went a little bit up and reversed. Now when you got here, you now notice that okay, the market is no longer going up. You now added a sell somewhere here, so to stop you from losing more money at 0.05, so you actually find out where the market is going to. So you can add another sell to lock in your profit, so that to stop you from losing money from this third trade. So that is just the technique, and that technique that is attached to it. Now when you hedge, it's always good to leave your hedging trade for about an hour or two before you actually know where the market is going to. Now let's take for example you notice that this level was a level of support. You notice that this level was level of support, and immediately price came here, you hedged, you bought and you sold. Now it's best for you to wait for an hour or two before you actually decide on where the market is going to. Now maybe you bought and sold at this level and the market retraced. It's not, now though the market kept going up and you now put your third trade somewhere here because of the retracement, it's wrong. Now even though the market kept going up, it might not be lucky all the time. Instead, it will be safer if you wait for like an hour. Let's say waited for this candle before you put your third trade, or even waited for 2 hours, waited for this second candle before you were now sure okay, this market is going up. Then you would have rode the market to probably this support, this resistance, or probably this level. If you rode it to this level, you would have gained 61 pips, and if you rode it to this level, you would have gained 110 pips or thereabout. So now you want to really get the direction of the market, before you pop in your third trade. You don't want to pop in your third trade when the market is still consolidating. You have to be very, very sure of where the market is going before you pop in your third trade. You don't just enter a trade hedge at the level and then you now begin to maybe enter at this place. You want to be sure that okay, the market has left this level and is ready to go before you actually put in your third trade. It will be very, very, because it could affect you psychologically when you just put in your third trade and next thing you realize that the market is actually consolidating. You could be very, very disappointed, and I don't really advise that. So I prefer you put in that you hedge at a good support or resistance. Then make sure that you are very sure of where the market is going, that you have found direction before you put in your third trade. And another thing I would like to tell you is that try to make sure that the gap between your hedging trades is very minimal. Now normally, let's say this JP Swiss franc is a 2 pip spread, which is small, but you can make it smaller, maybe to 1 pip or less than 1 pip. Let's say even it got say you took a buy at this level. Now instead of to take the second sell immediately, you can wait for the market to come down a little bit before you now take a sell, so that your deficit might be 0 or nothing, 0 or maybe half a cent, as you have half a pip, maybe half a pip, like it's like 5 points or nothing at all. But if you feel that you can't really wait for the market for you to go to the lowest level, so your spread might be minimal, you can just take it, buy and sell, and just accept the 2 pip deficit like that. But the reason why I say it might be nice, it should be nice for you to get in at the cheapest level possible. Let's say at the minimal volume as in level possible. Let's say you took your now let's say normally, let me calculate this. Okay, this is even too high. But let's say this is the normal um gap normally. Now maybe let's say when you could wait for the market to come down to somewhere here before you put in your second trade, so that you see that the market is not really up to a pip, so that when you put your third trade can easily go into the money, because the wider this is, the longer you should take your third trade to go into the money. Now now these kind of strategies are strategies that I only share with my students, but sometimes it's just cool to just help the public with useful knowledge, because if you think about it, I have nothing to lose when I do so. Now let me give you all another tip on how you can hedge properly. As I said before, to hedge you can just put a buy and a sell in, then once you find the direction in which the market is going, you put in your third trade. Another way to do this is to place your support and resistance across the chart. You could place your support and resistance across the chart. You can go to the 4-hour and place your support and resistance in the 4-hour, somewhere here, 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 here. Just place the support and resistance on the 4-hour at levels that you know that are actually strong. Then when you do so on the 4-hour, you can now come down to the 1-hour. You can now come down to the 1-hour and only hedge. Now next thing you do is to make sure that the market is at support and resistance. Then you put in your hedging trades when they are at that level, at either support or resistance. Now then when you are sure of where the market is going, you can now put in your main trade, which could be of a higher volume, as I said before, and write it down to support. Like if you got in somewhere here, you could just put in your buy and sell at this level. Then when you receive this confirmation or any confirmation of your choice that the market is going down, you can choose to write the market down to somewhere here. The market pulled back, but you can see the market still returned to this level. So you could have written the market down, or better still, you could have let's go to the 4-hour. Better still, I think this should be I think this should be another level. Maybe one here. So maybe there could be a level here. As you can see at this level, there's a few touches around this side. Personally, guys, I trade the daily, but I'm just doing this for the people that trade the intraday. So if you hedge at this level here and you put your third trade, you could write the market somewhere here at this level before, then take your profits, then hedge again, then seeing the confirmation that the market wants to go up, you put your third trade at this level and write the market up, and you hedge again at this level. You receive the confirmation that it's going down, you put your third trade and write it down. Just be bouncing, because that's what the market does. Just move from support to resistance. So you could just be taking advantage of that and just be trading, moving from support to resistance. Now, as I said before, make sure you trade at the right volume to prevent over leveraging. Once it gets to either support or resistance, check past information to confirm how good or that support or resistance is. That is very nice. Always check, go back to make sure that particular level is very, very strong. Now, because from my experience, support and resistance is the most important factor in technical analysis. You're talking to someone that I could easily tell you. I find it very easy to know where the market is going most of the time, not all the time, most of the time. And aside that, support and resistance work with numbers, and numbers don't lie. Support and resistance work with numbers, and numbers don't lie. They work with prices and numbers. Now, as you put in your third trade and write the market and profits, you see that your equity, your margin, and your marginal level percentage, your MLP, will increase. When you write the market to support or resistance, you want to see. Now, this is something you could do. Sometimes, like here, you can see the market got to this particular support, but it broke it and kept going down. So another thing you could do is when you get into your third trade, you could write it you could wait. When the market gets to a support, you could wait for the market to bounce. If the market doesn't bounce, like here, the market bounced and you would have taken your money here. But you could wait. If the market didn't bounce and the market broke through, you can stand chance to make more profit. Now, so that is just another way. But you can just choose to take your money at that particular support level. But if you want to wait, which could help you make more profit, you could just wait to see if it will bounce. And if it doesn't bounce and it broke through, then you can make more money. But if it bounces, then you can just take your money and watch out for the next trade. Now, when it gets to support or resistance, you can short all your trades down, or you can choose to take your money trade. As I told you can short all your trades down or choose to take your money trades. That's your third trade, which you traded at the volume of your choice. Because remember, the other first two trades they really cancelled each other out, so they are not really significant. So now that's the strategy. It's very, very helpful for intraday traders, but you have to understand support and resistance very well. So that's just what I wanted to share with you all today. Please watch this video again to make sure you really grasp the concept, since it's free information. So you just take your time and watch it again and again for you to really understand. And as always, experiment this on demo before you actually go live with it, and see if it's something you can work with. So thanks for watching. If you like the video, like it. If you love my work and you like what I'm doing, then you could consider subscribing, so you could get more information about, so you could get more updates and more videos from me. So, and also so you could be alerted when I drop a new video. So thanks for watching, and as usual, stay blessed. Till next video, stay blessed.